Good evening, ladies and gentlemen. When the financial crisis hit, our global leaders swung into action. G20 was forged out of the fires of the financial crisis. And everyone was full of talk of global harmony, global cooperation. You've heard the mantras, banking is a global business, therefore it needs to be globally regulated. But of course, over the months and quarters, it's become clear that despite all the global talk, an increasing amount of action is local. In part, this is probably an understandable misunderstanding in the sense that all the G20 leaders think, well, in fact, it's very interesting, the G20 leaders tend to talk the same vocabulary. Systemic risks, bad things, too big to fail, whole set of things. The words are the same, but of course in different countries and different regions, they mean different things by these words. And I suspect that every G20 leader probably thinks that global regulation means that other people are doing what they're doing. But we've certainly seen that in issues of bank taxes, of bonus taxes, very recently with the initiative of Germany on short selling, naked short selling, there's an increasing amount of local action. Now, I would call myself an internationalist at heart, whatever that means. And of course, we're all very self-selecting, so most of my friends are internationalists, and they're deeply disappointed by this development. And they feel this was a missed opportunity. We could have had a global governance, we could have had a single rule book of financial regulation spread across the world, that there'll be no place to hide for these bankers. We could have a global banning of all kinds of nasty products. And I guess my views have evolved, however. And I'm not really so disappointed. I think actually that it is inevitable that we're going to see a swing away from globalized regulation driven by the home country regulator of an international bank. According to some global rules, we're going to see a swing away from that towards a host country regulator according to host country rules. It bitterly disappoints my internationalist friends, my liberal friends. I don't think it's such a bad thing. And let me explain why. Firstly, I should point out there's a wonderful, unholy alliance between the big banks and my liberal internationalist friends in wanting global regulation. The big banks want it because they want to have a small, teeny-weeny bit of capital. They can move all over the world wherever they feel they want to invest again. They don't want to have any boundaries and ring fences for this capital, and this is highly efficient in their view. And they will argue that if you don't have that, then you've got to slow down capital flows around the world. This will be very bad for globalization, very bad for development. And indeed, I do think that we will see a reduction in the pace of cross-border capital flows. And I suspect that that is a price worth paying. The big banks like to argue, and my liberal friends join them in saying that, oh, if we don't have a global set of rules, there will be no end of regulatory arbitrage. Regulatory diversity means regulatory arbitrage in their view. And there's this unholy alliance which pushes this story. And they'll argue there will be competition, pushing down the lowest possible standards if we have these different rules. And I think those arguments are not illegitimate, but I think they're stronger arguments the other way. The first thing I would say is, and this has become far more obvious as we've moved from G7 to G20, from the narrow Basel Committee to the wider Basel Committee, there isn't one set of global rules that is appropriate for the world. If you go and speak to an Indian financial regulator, he has a totally different view about financial regulation than the man in Beijing, or the person in BaFin, or the US. That different countries have different structures of finance, different legacies of finance, different priorities. In India, financial inclusion is their number one objective. You don't need to worry too much about stability because the government still owns a big chunk of the industry. Very different priorities. So I think it's fanciful to think there is going to be one set of rules that are somehow appropriate for these very different levels of development, very different levels of structures of finance, and very different objectives. But the other interesting thing is that what we observed is that the common set of rules, then executed by home country regulators, was a massive source of regulatory arbitrage. Because under home country regulation, what we had was that the home country regulator viewed themselves as a global champion for their local banks. London was the biggest, I consider it freely because there are not many British people around the audience today. London was the worst offender. London London was proud of light touch regulation. Come to the UK and go global. All signing up to single global rules. You could argue that Iceland did something similar. So I would say that having a global set of rules enforced very differently across different countries is a substantial source of regulatory arbitrage. One of the arguments, one of the ways in which I was led towards the view that, in fact, we need more host country regulation is a view which touches on some of the discussions we've had across today as one of the fundamental problems of financial crashes. As you've heard me say before, financial crashes are not random. Financial crashes follow booms. Booms are caused by some collective belief that something has occurred that makes this time different. Some event has occurred which makes people genuinely believe, however misguided, that risks have fallen and they can leverage more, they can lend more, they can borrow more. And I think one of the key things that we need to do to try and reduce the next boom, reduce its amplification, reduce its frequency, is to try and tackle this by having rules counter-cyclical regulation. I think I'm a believer, and I'm going to upset many people here, but I generally favor market solutions. But I would say that financial crashes are a consequence of a market failure. And market instruments are going to find it very hard to solve this market failure. There's a mispricing of risk. Market instruments are not going to help us in this mispricing of risk. So we need counter-cyclical regulation. However, cycles and booms are not global. Take today, the mother of all recessions. The US is in a totally different place in its cycle than, say, Greece, than, say, Germany, than Italy, than China, than India, than South Africa, than Brazil. And yet we have a tremendous correlation today, which is not usual. So if you're going to do counter-cyclical regulation, you're going to have to be national rather than global. You might be regional, but you're certainly not going to be global. You do have a fundamental further problem, which is, and this Mervyn King, of course, put it so eloquently, that banks are global in life but national in death. As long as banks are being bailed out by local taxpayers, and taxpayers have kind of woken up to that, if in case they'd forgotten over the past 10 years, it's going to be very hard for local taxpayers to say, oh, it's okay, I will trust someone else's regulation. So as long as local taxpayers are the ones who are on the hook, then you're going to find a strong force for host country regulation. And that's why I remember it was a wonderful coincidence of two quotes. I think it was on the Monday in the FT a few months back. Dear Tim Geithner was saying that we need to further global regulation because banks are global, therefore regulation must be global. And then later that week, it may have been the Tuesday or the Wednesday, he's testifying to Congress, and he says, no one's going to tell us how to regulate our banks. So, you're not, as long as your local taxpayers are on the hook, host country regulation is back. So where does that leave the Financial Stability Board? In a world in which you would have home country regulation, so the home country regulator of an international bank using these global rules, the Financial Stability Board would have a very active active role to play, to come up with these global rules. Of course, I have to say that I am a little bit uncomfortable about the whole establishment of the FSB. It is more legitimate, more democratic than the Basel Committee or than G7, but that doesn't make it democratic or legitimate. And I think it's interesting to note that the one area where they've swung into action quickly is about attacking international financial centers who are not members of the FSB and the G20. So they're most tough on people who are not members of their group. So I think there's going to be a legitimacy issue and a democracy issue. I would say, though, that there are many things the FSB can do in a world in which there is host country regulation. At the least ambitious, it is a place where we talked earlier about transparency, about information, especially where you have international banks at work. This should be a place that regulators can speak openly and divulge openly and have full transparency of information. There's much talk, as you know, in the regulatory debates today of having more financial reporting of products and trades and settlement, and I think that all that to be collected, analyzed by the FSB would be useful. I think slightly more ambitious would be that the FSB is a place to deal with one of the key challenges of the Financial Stability Board and host country regulation, which is financial protectionism. So there are a lot of countries who feel vindicated that they had host country regulation and kept these nasty international banks and flows out, and reinforcing the view that they must continue to protect their markets. And I feel that's not a good thing. And a Financial Stability Board, perhaps on the lines of a WTO peer review process, could play an important role to ensure that whilst people can have different rules in different countries, these rules are focused on activities, not on the origin of the country origin of the bank. And then finally, perhaps most ambitious of all, is that it would be a venue in which we could encourage the convergence of regulatory principles. And the more convergence there is on issues where you can have convergence, the more we will facilitate cross-border capital flows, which I think generally is a good thing. So those are, I think, three things that a Financial Stability Board can do. I think the Financial Stability Board needs to be more legitimate and more democratic. I think there's going to be a shift, to conclude, a shift in regulation away from the notions of home country regulator following a global set of rules to the host country regulator. I know that people feel this is a missed opportunity, but I actually think it's inevitable. It's happening whether we like it or not. And I think it's a way to deal with the fact that economic cycles are local and different countries have very local conditions. One final point on how you would enforce it, because people say, well, you can't do that because banks are global or whatever. I think the way you enforce that is by saying that contracts, that all activity has to take place through local subsidiaries, which are regulated locally, that capital and assets are ring-fenced locally, and activity that takes place outside that regime, contracts are not legally enforceable in that country. When Swiss banks are lending mortgages to Hungary, who is most concerned about the systemic implications of that? The Swiss regulator, who doesn't care about what's happening in Hungary, it's a small country, or the Hungarian regulator? So that's where the locus of regulation should be, and how do you stop Swiss banks lending to Hungary to say that, well, that contract can't be enforced if the Hungarian mortgagee wants to say they don't want to pay up? So I think there are ways in which you can do, and I think it's inevitable, and I think it's the direction of the locus of regulation in the future. Thank you.
Thank you very much. Our next speaker is Erik Berglof.
Thank you, and thank you for inviting me. The last year and a half has easily been the most interesting and fascinating period in my life, and it's really been about firefighting, and I'll talk about some experiences, and particularly on sort of one attempt to try to plug a hole in the sort of global architecture. I'm also going to raise the issue of an institution like the one I'm working for right now, an international financial institution. What are the the incentives that it faces, and how could we think about the design of these institutions to make them more useful to help deal with some of these coordination issues that we see in the global system. And we just as to give you a sense that we have one region, which was the region most affected by the crisis. We had 1/3 in the financial institutions in terms of our investments. We had 1/3 in equity. So of course there were very strong incentives for this institution to get involved and try to deal with the coordination failures. So I'm going to come to more or less the same conclusion as Avinash. I'm going to come from a sort of very different perspective, I think. I'm going to see it more as a positive statement than as a normative statement that the host country rule will be the pervasive form. But let me come back to that later on. So just to give you a sense of what we were facing about, well, a year ago, a little more than a year ago. So this is now, I'm looking at the European experience, because I think that is at the very front line of what the issues you're facing in a global structure. But it is, of course, also very, there are some very specific European features. So this is the, and just to give you a sense of the complexity of the financial system of Europe, and focusing on the complexity of the system in emerging Europe. So here are the Austrian banks and their subsidiaries in emerging Europe. Here you have the Italian, probably the most prolific. You have the Swedish, I'll come back to that in a moment. Here you have the Danish, Norwegian. You have Greek, also very topical at the moment. So they are very important in Southeast Europe, and of course a major source of risk at the moment. You have Germany is active, Dutch, Belgium, France, UK a little bit, Ireland, Portugal is somewhat active. Hungary has its own cross-border bank. So once you sort of have this network of subsidiaries and parents, you can start thinking about the issues that we were facing a year ago. You had most of these parent banks being bailed out by their governments. There were very serious issues. Will these packages be allowed to be used for subsidiaries outside the country's borders? And if they weren't, which was, I think, a very probable outcome in the beginning, and many statements by politicians to that effect, that not a krona should go from Swedish taxpayers to the Baltic subsidiaries and so on. Had that happened, you could have seen what the host countries of these subsidiaries would have done, easily ring fencing, nationalization, and so on. So you would have started a very destructive decline of this whole system. But maybe the most serious collective action problem was the one that faced the individual banks and the collective banks. So we're really talking about a relatively small number of banks, maybe a dozen or so that really mattered. And you knew that there would be deleveraging, and if you knew that, you would like to be the first one to leave while asset values are still reasonable. But of course, as a collective, you would like to see a more managed deleveraging. This is essentially what we tried to achieve, and I come back to how it was achieved. So I'm going to make a few points. So first of all, obviously the crisis unveiled a lot of weaknesses in the framework of crisis management and regulation supervision in Europe. I'm going to describe what an initiative that we were part of to achieve this public-private sector coordination and also this host home country coordination in an institutional vacuum. And I'm going to come in to very briefly touch on what I think would be the appropriate framework, a bit in the spirit of what Avinash was talking about, and how to deal with which is the overwhelming trend towards host country regulation and supervision, and how can we avoid this build-up of buffers, both fiscal buffers and buffers in terms of international reserves. And I'll suggest that in the end that even this initiative could also be part of a European architecture and possibly of a global architecture. So just to summarize what I saw as the crisis threats, there were these risk of financial protectionism, there were beggar thy neighbor policies, deposit insurance, competition, increased capital requirements by individual countries and so on. In the end, we saw very little of this, and I think this initiative that I will mention briefly here was an important part of that. So they started in November, December 2008, first as a conversation among the banks and the IFIs, and also sort of trying to get policymakers involved. In January 2009, we had a meeting, the first meeting with home and host authorities and the IFIs in Vienna. That's why it's called Vienna Initiative. In March 2009, we had a first meeting with the banks, a coordinated meeting with the banks, IFI, and the home host countries. And we got an investment package and bank commitments to stay engaged. This then became a formal part of the IMF EU programs, first in Romania and then in all subsequent programs in Europe. And basically, there were the main component there was the commitment of banks to stay engaged, and then over time we would try to lower these exposure requirements. Finally, now this has become a sort of standard meeting that is. We've had several meetings in Brussels, in Athens, and it's now also trying to use this as a framework to address some of the vulnerabilities that were behind the crisis, particularly looking at foreign exchange mismatches and so on. And it's the same stakeholders, and by now it's 17 banks that are around the table. And I think the key here is that it's filled in a vacuum at the European level. It included supervisors and non-EU members, because what was clear was that there was a weak structure. There was very weak powers at the EU level to deal with the EU countries. But when you came outside EU, there was no coverage and no institutions to deal with these subsidiaries that were outside the European Union. There was created this platform for collective action. There was both policy coordination and mutual commitments. There was an ex-post burden sharing in terms of home host and the private banks. There was strong incentives for bank groups to stay engaged, partly through these IMF EU programs. And the IFA investments were also tied to these commitments, and some regulatory forbearance. And CEOs had to sign letters committing themselves, not legally, but in sort of public documents. So this was all part of it. And in the end, I said we saw very little of protectionism. We saw these home country packages were allowed to be used for subsidiaries. There was no foreign subsidiary failed. A very large number of local banks failed, but no foreign subsidiaries failed. There were essentially maintained exposures. It did help to stabilize individual countries, Romania, Serbia, etc. And it did, I think, contribute to building a market confidence. And the Eastern Europe actually had the lowest capital outflows despite the largest output shock. So here is just, I think this is certainly not a proof that this was the triggering event, but this is just looking at the timing of few events. And the Vienna Initiative came at the very peak of the CE weighted average of sovereign CDS. But I'm not at all claiming in causality here, but just to give you a sense where it came in time. Here's if you look at emerging Europe, this is during the fourth quarter, or the blue bars is the fourth quarter 2008 and the first quarter 2009, and during this period, Eastern Europe, despite this very large output decline, was the region that had the least capital outflow. So somehow the structure of the financial system and these coordination efforts seem to have helped, at least in stemming some of these capital outflows. Let me then just quickly come to some of the sort of more general issues that comes from this. This was sort of focusing on the crisis aspect of cross-border banking. I think it's very clear, and I show you this in the Baltic example, that this home country, and that Avinash was mentioning, the home country rule that was supposed to function. The easiest case where it should have worked was in the Baltics. It was basically 4 banks, 3 countries with subsidiaries. They were all they were essentially Swedish banks. It should have been very easy to fix this. We know what happened, that this was probably the part of the world most affected and most negatively, adversely affected by the crisis. And this, despite we had it of course was a period that it generated very strong growth over a decade actually, but there was a very fragmented regulatory and supervisory framework. There was a failure of regional coordination. All these efforts basically, when the crisis hit, came to nothing. There had been rapid credit expansion, asset bubble, massive FX exposures. Both these individual countries and the whole region actually was at risk. And the Nordics had to put massive support programs behind their banks. They had to take a swap line from the ECB to reinforce their reserves. They had to provide 1.8 billion euros to the Latvian EU IMF program. But most of all, of course, the effects were for the Baltics, with a GDP drop of close to 1/5 in 2009. And these countries are essentially still in recession, and they are all undergoing very harsh austerity programs. So, you can argue how much of this was due to the regulatory failures and so on, but it was certainly a feature of the financial integration and the vulnerabilities that had built. So I won't go into, this is a list of sort of what the different responses we will see to these lessons from the crisis, and I think they are actually somewhat different from Avinash. I think we are going to see a wave of harmonization, and I think we will see more coming out of this FSB process than I think Avinash suggested, but that's just a belief, and we'll see what comes in the end. But what is absolutely clear is that what's the most significant change is going to be the host country rule, and that's going to dominate. And I think there are, and Avinash was also alluding to most of these, that there are very serious issues with the host country rule. The host countries have very limited capacity. They are politically, much weaker typically. There are going to be very substantial increases in capital buffers and changes in business models of banks. It's going to come with subsidiarization and increased complexity. We're going to have more friction and more moral hazard. Actually, if you want to think about, too complex to fail, to my mind, maybe the most significant complexity you can think of is this cross-border aspect. And we're going to have a world that's going to be much more complex in that sense, I think in a host country rule world. And we're going to see overall fragmentation of the financial system, and possible reversal in financial development. Again, I do very much agree with the timing issue here, or the cyclicality, and that there are differences across countries, and I need to find ways of dealing with that. But that's and also now when it comes to the timing of introduction of these new rules that are coming from the FSB process, we have to be very careful not to introduce them when countries, for example, are still in recession. So the alternative is not really home country rule, because the incentives are fundamentally misaligned. If you take the Baltic experience, the Swedish regulator supervisors did in no way internalize what the Baltic countries later came to experience. So I think there is always a fundamental misalignment of incentives. There is a regulatory capture by large bank groups. So we need to find other structures, and I think in Europe there is some hope. The European framework that's emerging, I think, offers some promise, but it's very much untested. Let me just say that there is this Vienna Initiative that I mentioned that has these home-host country coordination and private sector participation. We have a new case maybe where we can try to see, these are the claims by banks on the Eurozone periphery, and you can see that there is very much a need to deal with these flows, and that purely sovereign or purely dealing with these as a problem of the individual fiscal balances is not going to help. There's a serious long-term restructuring problem, and getting private sector involvement is, I think, is critical to the solution. Thank you.
Thank you very much. And the third speaker on this panel is Andreas Botsch. You have the mic.
Yeah. I don't have a PowerPoint, just speaking notes, and as the last speaker before the conclusions, we're normally at a stage of a conference where most people in the audience tend to shift their minds to the concluding buffet or the reception. So I'll try to be brief and sort of don't don't repeat everything that's been said, but not just by everybody, that's me. And I'll focus briefly on the EU framework and legislative agenda that derives from the de Larosière report. Against the background of rising inequalities and the slashing of the welfare state, my constituency, which is workers across Europe, believe that the world of finance has been staging an undeclared war against them. And that's the background of what we believe is our genuine interest for a new financial landscape, as Peter Bofinger put it. The design of a new financial system or landscape is sort of designed to get out of the doom loop of continuing boom and bust cycles, and I think I can summarize them in a formula with 5 S's and 1 D. The direction which we would like the system of finance to take is that it should become smaller in size, slower in speed, separated functionally, simpler, meaning less complex in instruments and less speculative, and less short-term oriented, which, summing up these 5 S's, would stabilize the system. That's important to restore the fundamental role of the financial system, of intermediation, allocation and transfer of capital to productive use and to social use. and to roll back what's become the transfer of credit risk to society at large towards the basic banking system of risk transformation. Now, the D stands for democratization and the need to open up closed communities of financial elites and their networks to civil society organizations, trade unions, and other groups. And so far, the process of, oops, sorry. So far, the process of getting there has been very slow and shaky. I think you're all aware of the G20 commitments, which I don't have to repeat, and looking at the list of the G20 commitments, in terms of European, cross-border European legislation, there hasn't been much that's been done, apart from one directive on credit rating agencies, and only very recently things have been moving on. Now, on two of those items of the de Larosière agenda, we as trade unions have actually achieved quite considerable progress in getting our demands accepted or resolved, at least by one institution in Europe, which is the European Parliament, which is a democratically elected institution. And I'll explain some of the points now. In contrast to that, by the way, the European Council, which is the national governments in Europe, despite of their bold declarations on the necessity of having a European approach to regulation, the Council is a lot more reluctant, especially on the first point, when it comes to macro and micro prudential supervision in Europe. As Avinash was quoting Tim Geithner and his different proposals he's made in a very short time span of 2 or 3 days, I could quote Chancellor Merkel doing the same thing. Chancellor Merkel, who declared to a Congress of Trade Unionists in Germany, in Berlin, just 2 weeks ago, that she was very unhappy with the decision of the European Parliament to go for a real European system of financial supervision, and that she personally would prefer to keep it at national level. Now, on the 10th of May, the European Parliament has adopted its report on the macro and micro prudential financial supervision, and the important thing is that that's been done on the basis of a cross-party agreement among the European Popular Party, the Social Democrats, the Greens, and parts of the Liberal group. And that majority is important with regard to the upcoming negotiations with the Council. You're aware of the complex procedures of European legislation. And the main conflict, as I mentioned, is the European Parliament wants a truly European system of supervision with executive power given to the agencies, European banking authorities, European Securities and Markets Authority, European Insurance and Occupational Pensions Authority, and at the macro level, the European Systemic Risk Board. Now, one of the smaller achievements that we made is that we managed through Parliament to get seats with voting rights in the General Board of the Systemic Risk Board for trade unions and civil society organizations. Whereas originally this was really concentrated on the financial industry and central bankers. The second area is that at the beginning of last week, the Parliament adopted its version of the Alternative Investment Fund Managers Directive, dealing with hedge funds and private equity funds, and as such with a large part of the shadow banking sector. There again was a large majority, which will be important for the upcoming negotiations with Council, where in Council we had a split vote, 25 countries on the one hand, and the UK and the Czech Republic opposed to European regulation. For us, the regulation of hedge funds and private equity funds is important in different for different reasons. It's the European Parliament has called for a central register of alternative funds. It provides for a ban of naked short selling, which is particularly important for hedge funds. Then for private equity funds, there are provisions for minimum holding periods for portfolio companies, and most importantly, caps on leverage to be defined by the future European Securities and Market Authority. Sorry. And what I'm sure you came across in the media, there's the so-called third country rule, which we are particularly happy with, as it follows or addresses the footprint of all funds that are not domiciled in the EU, and who are used for tax or regulatory arbitrage reasons. We noticed the considerable protest from fund managers outside the European Union, in particular US funds and offshore UK funds domiciled on the Cayman Islands and elsewhere. Our line there is there should be a clear rule of the internal market principle to provide passports to managers and funds outside the union and ensure a level playing field. Now, the next three regulations that we'll be faced with is, I'll just mention them without going into detail. I think there's going to be a second directive or regulation on credit rating agencies in the aftermath of what's happened to the rating of especially the South European countries. And there's now a new thrive for a publicly owned credit rating agency. At least that's the ECOFIN Council that's declared its support for that on the 9th of May. In June, the Commission will come out with a proposal for a directive on derivatives, over-the-counter trade derivatives. And there's also, as you're aware, the discussion about the European initiative for a capital requirements directive 4 in relation with the discussion about a Basel III agreement. Yeah, I'll skip a few pages of my notes and just say that I would agree with Avinash's remarks on the lack of democracy of the Financial Stability Board. It's been very hard for us to get in touch with them and to talk to them. However, now it looks as if we've been recognized as stakeholders in the FSB process. And that we'll have regular consultations with the FSB at least twice a year. But by and large, our progress is more visible in the context of the EU framework and the College of Supervisors established there and the stakeholder groups of these financial supervision authorities on the micro-prudential supervision. So thanks, and I'll stop here.
Thank you very much. So the floor is open for discussion. We have at least 15 minutes, can go over a little bit, but we're almost catching up with time, which is great. Yes, Stefan. Are there mics somewhere? And I'll take a cue. Okay, teacher.
As in a series of questions first, then we respond.
I think I take a couple of questions and then the panelists will respond.
Just a few remarks. The first thing is that there would be, in my sense, some illusion to think that we can get rid of the cyclical nature of capitalism. The main point is to make sure that we can live with the crisis and keep this manageable, but we need to make sure that we don't create false promise and false expectations. And I'm more interested then in the discussion on the host versus home country, and I think the advantages and drawbacks of each system were very well presented by Erik Berglof. The only point is, it seems to me that the impact on other countries is a sort of a negative or positive externality of any regulation. And this debate in the financial sector has also some resemblance with the debate on the green growth sector on the issues of the environment. When countries take some decisions, let's say the US has some environmental regulations that have impact on Canadian forests, and the same things versus European countries. And the idea or the solution, and some things which I think have begun to be discussed in the US, is that in the process of impact assessment, of consultation, of establishing rules for a national regulator, to give the opportunity to other national regulators to comment as well, or have a process of consultation when the rules are being made, that the consultation is not only open to the national domestic constituency, but also to other constituencies, as I think is now being thought in terms of the environmental sector. And the second thing is to try to force regulators, to the extent feasible, when they have their impact assessment and cost-benefit analysis, to take it into account of the global effects or the beyond the border effects. I know that when we think of host country regulation, putting in place a system of consultation or impact assessment is maybe a bit ambitious, but still I think it would be good if you have these ideas in mind, to keep this in mind, and also to say that whether you put home or host country regulator system in place, it would be good to think about a few basic process tools of consultation and impact assessment, and make sure, to the extent feasible, that these tools could help to address some of the externalities that are at stake and that you are trying to resolve one way or the other.
Jeff Gordon?
I wonder if,
Mike, please.
Right.
Yeah.
I wonder if the panel might address what they expect the effect of Greece et al. Will be on the regulatory system that emerges in the wake of the financial crisis. That is to say, is this perceived as a knock-on effect, a new phenomenon? Will it significantly change the direction of potential reform? Will it lead to more protectionism? those issues as well.
Bruce?
So I was wondering, Erik, if you had the time, which I doubt, to run this thought experiment, and that is if you had all the listing of the banks in Europe, which you basically aggregated up to the level of the countries, if you had all this data, and then took a year. The problem is that this is going to change year by year depending upon the crisis. We know these correlations are kind of contingent upon certain external events, but if you did that and you kind of, ran some sort of analysis where you would, create modules of banks, groupings of them, whether they would correspond, miraculously to the exact number of countries in Europe, and accurately assign all these banks to those countries. So I'm wondering whether or not the spatial mapping of Europe is just not helpful. Really, it's just almost is almost arbitrary. Occasionally you get purely national shocks. I realize, but very often you don't. But if you did that, you might find that Latvia and Lithuania should be grouped with, Bulgaria in some sense, and Greece should be grouped, as we know now, with Portugal, et cetera. And it's better to kind of think about regulation in terms of these components as opposed to being kind of stuck by the strange history of Europe, which generates. I'll be careful here with sensitivities. Generates unusual groupings of people within certain borders.
If I just may add one question or comment or suggestion to the panel, I think sort of the contrasting home and host country regulation might not be so helpful. We probably need both. Certainly we need home country regulation of the consolidated entity and the collection of information for the consolidated entity, no matter where it does its business and whether it does this in subsidiary form or branch form. But I think I would also agree with Avinash that we want to have activities-based host country regulation. And that's somewhat separate from the conventional debate that only thinks about entity regulation and allocates then regulatory powers to either host or home. And those two things are overlapping, and I think then the key issue is something like the Vienna Initiative and other things to make sure that we have coordination between different regulators if push comes to shove. Then one more thought on Avinash's suggestion about the enforceability. When a host country then says no more of these type of activities, I like the idea at first saying you can't enforce these contracts, but obviously the parties will have agreed on a different type of form or different type of law, and you will enforce it elsewhere, and then you will have an arbitration award being enforced under the New York Convention, whereby the home country won't be able, the host country in that case, won't be able to even review the context of this case. And if you go beyond that, you might find yourself at some level in bilateral investment type of disputes for discrimination of foreign investors. Plus, within the EU, given sort of the complete prohibition of restrictions on capital flows, not only vis-a-vis other member states, but also third parties, we have serious legal constraints by the treaty to do these kind of things. And we have to remind ourselves what are the constraints and institutional setups that we have already created that will be difficult to change. But I would like now to give the panelists a chance to respond. Shall we just go in the same order that we started? Avinash?
Dealing with the cycle is the key biggest thing for financial regulation. The objective is not to kill the cycle. You can't do that. The objective is to make sure that your financial system is not amplifying the cycle. That is what our financial system did. It amplified the real economy cycle. What you're trying to do, we do not have the calibrations necessary to be very precise about what we do with the cycle. We are leaning against the wind. That's the best we can do to try and dampen the real economy cycle as the conduit through finance. And indeed, that is perhaps the lesson of the current European financial crisis. I don't think Greece in itself casts much of a shadow on financial regulation. It says a lot about the whole issue of how fiscal policy is managed within Europe. But interestingly, the contagion is onto Spain and Ireland. Spain and Ireland are two countries that were the poster children of the Maastricht convergence criteria. They ran surpluses, they reduced their budget debts, debt-to-GDP ratios, and then the financial crisis hits and they become almost the worst offenders. And that tells you the importance of dealing with this boom-bust cycle. Because even so, for 10 years they're trying to do the right thing, and it takes one crash, which may well have started somewhere outside their own country, perhaps the United States, with subprime, etc. And that's why, the deepness of the crashes are directly related to the heights of the boom, and that's the thing we need to deal with. In terms of enforcement of host country regulation, there's a big issue is going to be within Europe. And Europeans will feel that host country regulation goes against the laws of Europe, goes against the ethos of a single market. I actually think, and I know I'm not going to win that debate within Europe, but I actually think it is a significantly missed opportunity. Because the way to strengthen the euro, to make it more resilient, is actually to give more instruments in the hands of policymakers. And when you had in Europe, as we did do, booms in Ireland and Spain, but no boom in Germany and France, one single interest rate, that was part of contributed to the problem. If you had host country regulation that could have been allied, trying to dampen the booms in Ireland and Spain, that would have actually ultimately strengthened the euro. And so I think this resistance to host country regulation in Europe will actually serve to undermine the resilience and integrity of the euro.
Okay. So I certainly agree that we need to have both host and home country rules. I think what I think both Avinash and I were talking about is the change in balance, and that what we're going to see, whether we like it or not, is a shift towards host country regulation. What I think, and that has more to do with the politics of this and the inacceptability of host countries to be at the sort of receiving end of these fluctuations, and you can't really defend not being able to control the sort of critical instruments of regulation. I'm a bit more optimistic, as I said, in terms of what's going to come out of the FSB process. It's been a very sort of low-key and maybe not fully sort of engaging process in terms of outside stakeholders, but my sense is that we're going to see a number of quite important outputs coming from this process, or even over the next year. And if you want to deal with a host country, a world of host country regulation, harmonization is absolutely critical, and I think we will see more of that than maybe we would have thought. In terms of Greece, I agree with Avinash. The Greece is not about financial regulation. It's about it's about the weak sovereign, and it's about fiscal issues. What may come out of this is that what's on the table now is again various forms of sort of fiscal federalism at the EU level that we have broken through several taboos in terms of the sort of ex-post burden sharing after the crisis was definitely more than anything we had seen in the past, and I think now with the recent decisions on creating these new SPV and so on, these are fundamentally new steps for the EU, and this may also in the end come to affect what type of financial regulation can we see at the EU level. I think on Bruce's question on the difference between countries within Europe. Well, I think what we have seen is that there's been a lot of convergence in terms of the real business cycle in these countries, and so there is this sort of endogeneity to the European integration process. But what we haven't seen is really a convergence when it comes to inflation and pricing, and that's what we are seeing now, the consequences of in the periphery, and that's whether we'll see that or not is still an open issue, but certainly all the efforts now to learn from this is to try to see how can one achieve a more convergence in that area. So again, I don't disagree that there are important differences and we need to recognize them when we do regulation, but I think there is also a long-term convergence process.
Andreas?
Yeah, 3 points on the questions that have been raised. I also believe that at the heart of the South European stroke potentially future Ireland crisis, it's basically macroeconomic imbalances that markets have taken advantage of rather than regulatory issues. And on the other hand, we see that the effect of the Greek crisis, at least, has had quite a positive impact on the regulatory agenda. At least when you listen to people like Angela Merkel and Nicolas Sarkozy and the president of the Eurogroup, Juncker, who've all declared that now the regulatory agenda needed to be sped up. Now the internal macroeconomic imbalances within the Eurozone, I think that's a completely new subject. We could hold a different conference on. But there again, I think the agenda is moving, even if it's not moving in the right direction from our point of view. I mean, we would have preferred to use this crisis as an opportunity to overcome the congenital flaws of EMU and start perhaps incrementally with the issuing of Eurobonds. Now, you could say that the ECB, in circumventing Article 21 of its statute and purchasing sovereign bonds on the secondary market, is or has almost the same effects than issuing Eurobonds, at least when those sovereign bonds of Greece and Spain are sterilized. But it's accompanied not by moves towards a mechanism that could overcome imbalances like fiscal Europe or at a later stage political Europe, but it's it's accompanied by a stability and growth pact which will not work, simply not work, and which will provoke one stabilization program after the other in the next decade to come. And so the uncertainties about the euro will actually increase. Short remark, host or home country, I think a true European system of financial supervision would actually overcome this more sterile debate on where the preferences are. And can I conclude with, as we are just 100 and something blocks away from Wall Street, over lunch we had quotes from a movie, Allen movie, and I'd like to turn to music, to lyrics. I think The Bankers, one of the favorite songs of bankers at Wall Street and elsewhere, must be the Beatles song Across the Universe, because across the universe, bankers, despite of the crisis, tend to sing the refrain, nothing's going to change my world, nothing's going to change my world, will be bailed out in any case. And I think our role on the trade union side is to remind them the album title that the song is on, and it says, "Let it be."
Thank you very much. On that note, let me please join me in thanking our panelists for wonderful presentations, and thanks for you for participating in the discussion. So let's do that first. And then I would like to ask Patrick Bolton to come forward and give his concluding comments to the entire conference, I believe.
Thank you very much, Katharina. I'll try and be brief, given that we're all tired and we've had lots of very good comments. We've learned a lot in a very short time space, and I would like to start where Andreas just left. He said, he referred to the Let It Be Beatles album, But Susan Bice, she started with Groundhog Day, one of my favorite comedies. And she tried to make the point that, well, often you don't get it the first time, and until you get it, your experience is going to get repeated over and over again. And she took that away from Groundhog Day. But the other aspect of Groundhog Day, for those who've seen it or you remember it, is the arrogance of the main character, right? It's not just that he doesn't get it, he's super arrogant. That may also be relevant when it comes to the financial world and financial wizards, financial engineers, etc. So continuing on what Susan said, she mentioned that at the firm level, there are some lessons to be learned from the crisis and some improvements to be brought. One first lesson that I took away was the silo problem that she mentioned when you look at the corporate governance of a large financial institution, where you have a compensation committee and you have a risk committee, and they're not talking to each other. So I thought that was rather instructive, that somehow the whole governance process was that we could separate risk analysis from compensation. The other point that she made, which struck me, which I think probably would be material for another conference, for the next conference, if there is enough research being done on that. So she mentioned the work of a risk manager in a commercial bank. What is it? How do we think about a risk manager or a chief risk officer in a commercial bank? And she alluded to the idea that the risk manager is like a line manager. And that is actually very appropriate. That if you think about the risk management problem inside a bank, it's all about reining in the risk-taking incentives of the traders. And she said that's a losing battle from the side of the risk manager. The risk manager often is not senior enough, doesn't have a senior enough position, doesn't have the authority to push the traders back, to force them to take less risk, to force them to provision against the risk they're taking so that their bottom line will be lower and so that their bonuses will be lower. That's an enormous incentive problem from the bottom up in a financial institution that we haven't even talked about, which I think would be a very good topic for our next conference. So let me now move on in my remarks to what I think were the areas of consensus that I detected from all the discussions and potential areas of disagreement. Perhaps I wasn't sure whether Wayne Guay would agree with that, but I detected that even Wayne Guay felt there was a need for some kind of intervention, that there were gaps in compensation policy, that there was a need for regulation, and that there was a need perhaps of better governance. And pretty much everyone else focused on one aspect or the other, and Charlie rightly highlighted that maybe it's not all about compensation, that it's maybe also about governance, and it may be also about regulation, and it may be also about politics. We all agreed about that, I think. Then we had disagreements about which was more important. Now, my view on that is that let's not emphasize our disagreements on what's more important. Let's recognize that we need everything. We need regulatory response. We need to fix the politics of regulation. We need to improve governance, and we need to improve compensation. These are not exclusive. At every step of the way, we can working on all of these fronts. we can improve the stability of the financial system. So in particular, one of the important points that emerged, for example, on governance from Harold Howe's study is that at least in the German banking case, it was really mostly a governance issue and not a compensation issue. That's one example I want to bring up. Now, over lunch, we had Henry, who made, I thought, a very thoughtful comment, and essentially, to a one-line summary of his comment was, if you don't regulate pay in banking, then you will need to focus more closely on other forms of regulation, and that is, in my view, a real trade-off. That in terms of in more general economist jargon, we have an incentive problem in banks. We can deal with it either by focusing on inputs or on outputs. And what Henry was saying was, in a complex financial system with a lot of innovation, focusing on inputs is getting harder and harder. Therefore, we need to focus more on outputs. And I think that's a real trade-off. I thought that was a very interesting takeaway from his presentation. Let me quickly conclude, and I may not be give full justice to the last panel on, what's a better approach, global or local. I was persuaded by the comments that were made that at some level only a local response is feasible. If I can detect a consensus in what the panelists said on the last panel, it is that everybody seems to agree that requiring multinational banks to have wholly owned subsidiaries in each jurisdiction seems like a good idea. So at least with a takeaway. Oh, Katharina, you're disagreeing. Anyway, I thought that would be an area of consensus. But let me finish. This will be my last set of comments on taking a little bit of a broader perspective of where we are today, and a perspective that speaks to some of our debates on short-termism on the one hand and excess risk-taking on the other. Okay, so here's perhaps a dangerous analogy to make. Taking the long view. What is a precedent in history for where we are today? Well, there's never a complete precedent, but you could argue that 1910 might not be such a bad precedent, right? 1910, we were living in a world that had reached a peak of global integration. We had, by the measures of the time, very sophisticated financial markets. We had the inventor of, Louis Bachelier had emphasized efficient market hypothesis, that stock prices are a martingale. He had discovered put-call parity. There was a lot of financial innovation. London, the city of London, was an incredibly sophisticated financial center. We emerged from a major financial crisis in the US, 1906 or 1907. We emerged of a war, Russia, Japan, that we sort of, we thought we had, gotten the best of. We had everything under control. So from the point of view of someone in 1910 looking at the remainder of the 20th century, things looked pretty good, looked under control. Okay? People would not have forecasted World War I, the Great Depression, World War II, and all the enormous changes that the world went through in the 20th century. So, that seems to me, if you say, well, what can we expect for the 21st century? Well, very few people ask that question. What's going to happen to the world over the entire 21st century. That to me is evidence of short-termism. The fact that so few people focus beyond 2 or 3 or 4 or 5 years is evidence to me of short-termism. Now, evidence that we're having excess risk-taking, similarly, maybe, and I may be exaggerating here, is, before the financial crisis, what did we hear about in economics and in finance? Well, we heard about the efficient financial markets on the one hand. Well, that's fine. We also heard of the great moderation, that somehow volatility in economic activity, everything went down. The central banks had everything under control. They knew how to manage the macro shocks and basically reduce macro instability, and we had basically reached a new era. Okay, well, I think again, from the point of view of those who were arguing that we were in a new era of great moderation, well, they were missing the fact that there was a lot of risk being taken by very highly levered very large financial institutions. So that will be my last word.
Thank you very much.
After those uplifting words, very thankful for all of you coming here and coming to the very long distance. We appreciate that. And our thanks to the participants for financing this event. Also to many people who helped us here, who we thanked earlier. But it's been very important that we had your assistance and you've endured this conference as well. I wanted to ask one thing to you, Patrick. It seems to me that one has two choices, given what you explained about this. One is to think long term. The other one is that old expression called seize the day. Our job, actually, one thing we financed was the drinks out here. So perhaps if you're feeling really depressed, you can look at that. And I'm looking over behind that. I've never seen actually a bar quite as interesting as the one we financed. I guess this is the faculty club, which I thought was going to be wine and beer, but it looks like you can drink to your content on many kinds of alcohol, which I guess are under national regulation, if not international. But thanks very much.